Hey, if you're watching from home, thanks for jumping on. There's a live chat um, as part of this, and bear with us. We have not done a YouTube live like this before. We're using a different bit of software in the back end. Scott is waiting in the wings. Um, but look, if you've got any questions throughout the presentation, just pop them in the chat. And if you're brave enough, can you potentially give me a hello in the chat where you're watching from, just so I can see that the chat is working? We've probably got about a bit of a delay, 10 seconds, 15-second delay. So that's why we'll wait till the end to see any questions from you. But yeah, welcome to Monday night. I'm your host, Glenn James. Well, what I might do, I might invite Scott Taylor from Everest Wealth. Oh, Daz, watching from Vietnam. Well, would you look at that? See, I've got to not get distracted when people like Daz say that they're from Vietnam. Scott, do you want to unmute and video? Hey, mate, how are you?
Very well. How are you?
Good. Hey, thanks for joining us tonight on
My
this
pleasure.
live stream. Can you tell a little bit about yourself, Everest Wealth, and I'll give a shout out to Natalie from Brisbane, Candice in Greece. Far out, we've got all these
Far
international
out.
people.
What time is
Candice,
it in
take me
Greece?
to Greece with you. Far out,
Yeah.
that's awesome. And yeah, so tell us a little bit about Everest Wealth and where are you coming from tonight?
Yeah, unfortunately not in Greece or Vietnam, but yeah, no, in Perth, Western Australia, on the other side of the country.
Yep.
Um, Everest Wealth. So yeah, we've been around 7 years now. Glenn just ticked over the 7 year mark last week. So myself and Alex Luck, who's been on the podcast a few times, started Everest Wealth, and the whole aim of Everest Wealth was to help the younger demographic be able to, I guess, get advice earlier in their life, and that's what we're really passionate about. So predominantly we help people under the age of 50. A lot of what we do is one-off advice as well. Also do offer ongoing advice, but that's our kind of mantra for helping people all across Australia.
Yeah, awesome. Now, I will say, everyone, tonight Scott's going to work through a case study that was an advice document. I understand, Scott, you've changed the names and some key details, but they are wealth accumulators. And we really wanted to just show a little bit under the hood of a real life scenario who engaged Everest Wealth, a financial advisor, and what they did for this client. Was it one of your clients?
Yeah, it was. Yeah, someone I saw about 6, 7 months ago now.
Right, right. Okay, so at least you're on top of it. And then I will say as well, if you've got any questions throughout it, throw it in the chat, and we'll get it. If I pick it up along the way, we will. But if not, we'll spend as long as we need to. And I just wanted to show people the value of financial advice. And as I say, price is what you pay, value is what you get. Now, I understand I've got Ryan here in the studio with us. Ryan, the audio's fine. We think people can hear us well. Awesome. Good, good, good. And I'm just going to, sorry guys, I'm just setting up my little screen here because I want to be able to see the chat as well. Gorev, if that's how I pronounce your name. Hello, Scott and Glenn. Hey, it's Glenn with one N. Good to see you. I've learned a lot of strategies from Alex's YouTube video. So, well, should we get straight into it, Scotty boy?
Yeah, let's go, mate.
All right.
Let's do
So
it.
we'll start by saying Everything that we talk about tonight is general financial advice only. You'll see my disclaimer there and Scott's disclaimer there. So please read that, acknowledge it, remember it. This is all general advice only. And it's clear that's a lot of words. So, okay, Scott, talk us through this situation in total and take as long as you need, and then let me know when we can kind of go to the next page.
Yeah, awesome. So Neil and Louise came to us in their mid-30s, in kind of somewhat usual occupations of a tradie, plumber, and just a manager, which was a white-collar kind of office duties role. Kind of normalish incomes in terms of $94,000 a year and 115, so kind of a household income just over $200,000. Super balances pretty in line with people in their early to mid 30s that have been kind of PAYG employees their whole life since their early 20s. A little dabble in investments to date, just from doing a bit of their own research in kind of an index fund of the ASX 200 and US kind of top 500 through Superhero, and then bought a house. It was about 3-4 years ago now that had gone up a bit in value. So their principal place of residence was $1.5 million that they got just before kind of COVID started. So that's taken off a lot. Debt of 880 grand. So that's on their principal place of residence. But they also just recently sold an investment property, and again had gone up a lot in value that they got even longer than that, about 7-8 years ago. And after paying off the debt on the investment property, they were left with $342,000 of cash.
Right.
There was a gain of that within that property of $391,000, but because they held that investment property for longer than 12 months, they got a 50% discount on that capital gain. So their gain was $195,500 in total. So half of that on Neil, half of that to Louise.
So just on that, so they had the PPOR and the investment property from another life. Did they live in it first and then upgrade and keep it? What was the story there?
Yeah. So they never lived in the investment property. So there was no kind of, we couldn't apply any main residence tax concessions or anything like that. It was purely investment property that they bought together, but they did buy it before. They kind of did it in reverse. So they bought an investment property ages ago for went kind of all the first home owner schemes and grants and stuff like that, and then did the principal place of residence after.
Hey, yeah, and there is a question there from Gaurav, if that's how I pronounce your name. Please correct me phonetically in the chat. He said, was the investment property sold after seeking the advice? And it kind of leads to the question I was going to ask you. When they rocked up on your doorstep, did they say, hey, what should we do? Or, hey, we've just sold this property, we've got all this cash, what should we do? Or did they have all these goals, or did you work with them to get their goals and objectives out of them? Talk us through that.
Yeah, great question. So in this particular situation, Neil and Louise had already sold. So that's where the driver on the right was really, this is the most cash we've ever had. We want to be smart with it. We've heard that we're going to get a big tax bill. Is there ways we can mitigate that tax bill? So that was like the driving point for seeking advice. They were in a position where they thought like they were a bit out of their depth with their own knowledge. But in an ideal world, we would have seen them prior to selling. And I'm not saying that we would have advocated for selling or not, but we could have run more numbers around the benefits of keeping it, maybe from an ongoing tax point of view and potential future growth versus selling and redistributing that cash elsewhere.
Yeah, so we know that there was a bit of meat in that property already, and I think maybe some of the strategies that you're going to talk about, around that potentially debt recycling and whatnot, they're depending on their risk profile, they could have kept that investment property, borrowed against it, and leveraged into equities.
Yeah.
But again, this is all speculation, and we're here now. And I think we just need to know they've knocked on your door once this money's in the bank
Yeah.
effectively, and then you had to work through the best way forward.
Yeah, and that's where then we kind of, with everyone, we sit down and start working through what's the longer term picture. And some people can be quite specific with what they want to do or achieve. These people, as you can see, are relatively specific around, like, all right, we're in our mid-30s, we want to try and start a family now. We also want to be debt-free kind of by the age of 50, so 2040, so that we can potentially have the option of early retirement. A lot of people we speak to want the option. They don't necessarily feel that come 50 they want to hang up the boots, but they want the option. So doing things when you're in your 30s and 20s and to an extent in your earlier 40s can really set yourself up to have those options. The longer you leave it, the harder it is, or the bigger shifts you need to do to get yourself in a position where you can potentially partially or fully retire. So these guys were quite specific around their goals once we started delving a bit deeper. But it's also okay to work with goals that are more broad, like I don't really know. I just want to put my money in the best place or mitigate tax or build my wealth in the best way. And then the goals come at a later point when people understand what position they could be in. Because sometimes it is hard to I guess know what's even possible and what's a realistic goal as well.
Yeah, 100%. The emergency fund, did they have that figure in mind when they rocked up on your doorstep, or was it just, oh, we think we need a cash buffer?
Yeah. So that's what they had in mind. But after we worked through it, we got some income protection in place that had a 90-day waiting period. And they already had a bit of sick leave, so we could actually drop that to about $15,000 or $20,000.
Yeah.
But they still opted to keep 30, which gave them more peace of mind. And I guess that goes back to we don't, and nor do any financial advisor I've come across necessarily dictate what someone does. It's more we work as a team to get to the ideal outcome for them, and they're making informed decisions. So we ended up keeping 30 grand because it was sitting in their PPR offset, which is still at the time saving them 6.09% on their interest there.
Yeah, sweet. All right, well, let's have a look at a bit of an approach of what you did. So I'll hand it back to you with the cash flow, super, investments, and all the other things.
Yeah, awesome. So any financial plan, the foundations for us, it really starts at the cash flow part. And that's having, firstly, a good idea on what you want to achieve or your goals, but then from there, having a really good spending plan. And there's plenty of kind of ways you can go about that, no more than your own spending plan, Glenn, but having a good spending plan then helps us know what money comes in, what money goes out the door, so what's left over. Because then we can start plugging in different scenarios of if Louise was to take 12 months maternity leave and then return 3 days a week with 3 days of daycare, if nothing changes with their spending, are they still going to be in a surplus position, or are they going to be in a deficit? Do we need to keep some of this $342,000 in cash aside to fund that next stage of their life so that they've got no financial stress and having a bigger emergency buffer? So that's kind of the first aspect of it, is to really set a spending plan. Budget is something that not many people resonate with, setting a budget, because it makes people feel like you're going to
Restrictive.
Stop spending money. But it's more just an agreeing on a spending plan. And sometimes we increase people's spendings to particular areas, whether that's holiday or fun stuff or whatever it may be, because that's more aligned with their goals. So that was the first aspect. And from there, typically comes a bit of a restructure of the accounts, maybe a few new bank accounts, so forth, depending on what we're going to do. So for this, there was kind of 2 new offset accounts that were opened, one for the purpose of holidays, to really set aside that money on an ongoing basis, and the other one was to split out where they spend their essential spending like bills and groceries to more of the fun stuff like going out for a meal or takeaways or retail shopping.
Yeah, great. And so I'm just going to go back.
Yep.
What was the the capital gain?
Yep.
Okay, so they had after the tax, it was about 195,000
As a gain, yeah.
as a gain.
That was going to get added to their taxable incomes for
Yes.
the financial year that's just
Do you have
finished.
off the top of your head the net wash up of the sale
The like
after
the cash
tax?
after, yeah. So the money left over, is that?
Yes.
Yeah. So they pretty much had no savings before
Right.
they sold the property. So the net
Right.
wash up was pretty much the 342
Right. Okay. After the tax. Oh yeah, 342,
before
390. Yeah.
tax.
Yeah.
Yeah.
Sorry. Yes.
So yeah, if they get a tax bill, which invariably they would with that, that would have to come out of the $342,000.
Yes. Yeah.
Yeah.
Okay. So talk to us here about this PPR loan
Yeah.
and the debt recycling strategy that they embarked on.
Yeah. So one of the things that we considered was going back into the property market and leveraging again. As we worked through the forecasts on that and I guess the outcomes of that, it wasn't a priority for them. And that was more so from the ownership of property and having tenants. They didn't really like that process over the last number of years, so they didn't want to get into another property. So that was relatively early on in the piece discounted. So then the options that we have then are to invest in the share market or to pay off their principal place of residence debt quicker. Like in a nutshell, they're two of the main options. Yes, there's superannuation, but I'll get to that. So we could just use some of that $342,000 and just straight into an investment. What we did want to look at though was, does it make sense to put it onto their mortgage and then effectively pull that money back out? So they're in the same debt position as they are when they saw us, but now some of their debt has been recycled and has turned into an investment loan. And the benefit of having an investment loan, the interest that they pay the bank is then tax deductible.
And we might get onto that later because people might have some questions, but talk to us about super.
Yep. So then the other aspect of this was to try and lower their immediate tax bill or impending tax bill for the financial year 2025 through the $195,000 capital gain that they have. It is very hard to lower that tax bill. Super is the main way that they had available to them to reduce that. And as many people would be aware, the cap for putting money into super is $30,000 per year, and that includes salary sacrifice contributions or what your employer puts in, which is now just ticked up to 12% of your wages. However, what we looked at for these guys is because they had a balance of under $500,000, they could look at making catch-up concessional contributions. So that allowed them then to go back over the last 5 financial years, 6 including the one we were in at the time, and make a contribution over and above the $30,000, and then use previous year's cap space to make a bigger contribution in one go to really lower their taxable income. So that was the main aim, was to lower their taxable income. And they did have about $100,000 each catch-up contributions available, but they didn't want to use all of that because the big downside is of their age and putting money into super, the accessibility conversation around I'll lose access to that money for a good 25 years. So that's where we ran different scenarios of fully doing it, not doing it, maybe somewhere in the middle. And what resonated for them was somewhere in the middle, and they ended up doing $35,000 each, which was still using those provisions, but not all of those provisions.
Yeah, cool. And then there was $100,000 in a joint investment account into 5 exchange-traded funds. So effectively, there was an equity loan of $100,000 that was then moved into CMC markets.
Yep. Yep.
Yeah.
So yeah, that's not another $100,000. That is the debt recycling $100,000 that then got invested via that method.
Superannuation, brighter to CFS. What was the rationale there?
Yeah.
And I
So
don't think I've heard of brighter, and that doesn't mean anything, but
yeah. So
I mean, there's
yeah,
lots of super funds.
Brighter Super is out of Queensland mainly.
Right.
The main thing we look at when we review people's super funds, two main levers. Firstly, the fees. Most super funds charge 3-4 percentage-based fees and sometimes a dollar-based admin fee. So the crux of it is to see if we can lower that. Now lowering the fees isn't the be-all and everything of it, but it certainly is a guaranteed saving. And particularly for these guys where we're starting to pump in a substantial amount of money and really boost their balances, that was going to increase their fees quite substantially. So being able to lower the percentage-based fee enables us then to have more money compounding over the long term to be keep in their pocket. The other lever that we looked at was moving more to a high growth investment option, given their time horizon of accessibility to super, to gain more access to the share market and property and infrastructure that historically makes more money over the longer term than defensive assets like fixed interest and cash. So that after kind of there's 170 odd super funds in Australia, we're not aligned to any of them. And for Neil, CFS kind of was the one that best suited him. They also didn't want to be in the same super fund to mitigate risk of performance and stuff like that.
Yeah, right. And that's actually, it's funny there. And that's what I was going to ask you rather than, knocking on your door and crapping all over your financial advice. But and if you have just joined us, this is a live case study of an advice couple that saw Scott from Everest Wealth. So just put questions in the chat, say hi, where you're coming in from. It would be remiss of me not to say give this video a like because it's YouTube, and that would be awesome if you did that. But so basically, that was my exact question. If CFS was good enough for Neil, why wasn't it good enough for Louise, and vice versa?
Yeah, well, at the start we were suggesting Neil goes to Host Plus.
Right.
We felt that was the best solution for Neil at the time, but then they just didn't want to be in the same fund because with most super funds there's no like spousal discounts or family discounts really. So it was more a risk mitigation method in the end for them to not have all their money tied up with one investment manager. Now, at the end of the day, we entered more passive-based investments, which are also referred to as index funds, which broadly are going to return the same. But for these two, they did want to keep that separate. So that's why, again, it ended up being a separate recommendation.
Yeah, okay. Talk to us about the insurances.
Yep. So I guess part of any plan is again laying the foundations. Foundations include an emergency buffer, a good solid cash flow plan to know exactly where your money is going, but then also insurances. So most people have some default levels in their super funds already. So it's looking at what they've already got, what are they paying, then having a good look into their health history, so they tell us more sometimes than what their doctor knows. And then we can just go to all the insurers out there and just make sure we're choosing the right product or insurer for them. And for these guys, the most important one was income protection, given they've got commitments, ongoing commitments of mortgage and bills and so forth. So covering their income was really important. They didn't need too much life insurance at the moment. They just wanted to cover half of the mortgage each. So if one of them was to pass away prematurely, doesn't leave the other person having to sell the home straight away. They've got options. Permanent disability, because of their age, again, if they can never work again, they're giving up a lot of future income earning potential. And then trauma, that one pays out based on diagnosis of 45 typically 45 diseases such as cancer, heart attack and stroke, so an injection of cash to help with medical costs. So effectively, they just wanted to future-proof that if anything bad was to happen to them, to put them out of work or a bad disease or premature death, that financially they weren't exposed or leaving the other person exposed. And then the last point there was, or probably make two other points, they look to pay the income protection out of their own cash flow rather than super, which most people pay for it through super. And the reason for that was they had a good kind of cash flow surplus position and it's tax deductible. So they wanted to preserve more of their super for their future growth, knowing that they may retire earlier in life, so they may not have 30 plus years of contributions. So they wanted to kind of future-proof that, but also get the tax deduction on that payment. And then just the last point there, Glenn, was just around transferring Neil's existing insurance. That's because he had, I think it was a previous back and knee injury, which would lead to an exclusion on a new policy. So we wanted to keep that cover that Neil had with Brighter Super, and we were able to move that like for like to his new super fund with CFS.
So CFS effectively did what, a group insurance takeover type term, did they?
Yep. So it's just answering about 4 or 5 questions like, have you claimed on workers' comp before? Are you intending to go see a doctor? Has anything really massively changed in the last 12 months? Assuming you answer no to those bigger ticket questions, then some super funds allow you to move the insurance as well as your super, if you're moving your super balance as well.
Yeah, okay, cool. All right, let's keep going. Talk to us about the cash flow outcomes.
Yeah, so I guess we've already spoken about some of these recommendations, but what's...
Or maybe the outcomes,
Yeah, what's more of the tangible outcomes? Because working with a financial advisor, there's going to be tangible outcomes, but there's also going to be the other side, which is more peace of mind or greater clarity, whatever it may be there. So with setting the spending plan, that gave them greater peace of mind that Louise could take 12 months of maternity leave and then only needs to return to work 4 days a week, and they'd be in a positive position, be able to afford daycare, all of that stuff. So that then provided them great peace of mind there. We decided to put their surplus of $400 a week into the offset account just to keep building up greater flexibility of their money to then potentially do another round of debt recycling in 12 months' time. So they wanted to do the initial 100. Let's see how that goes. Let's catch up in 12 months, and then maybe we do the $400 a week, which would equate to $20,000, or maybe we do more, maybe we don't do it at all. But if they didn't do that, then they would be debt-free by their target date of age 50 or 2040, and at the same time would have saved nearly 300 grand in interest. Now that's based on obviously a 6% interest rate, and we know rates have been coming down, and they didn't this month, which was a big surprise. But yes, even just doing that conservative play there still saves them a lot of money. And then finally, the debt recycling strategy, that $100,000 debt recycling or equity loan introduces $3,000 in tax deductions each based on a 6% interest rate. So on a $100,000 loan, 6%, $6,000 a year in interest payments to the bank. They can halve that each, so $3,045 each as a tax deduction, which based on their marginal tax brackets of 32%, gets them about $990 positive tax benefit each year. So that was and that's an ongoing one. And obviously, if they keep debt recycling and reduce their non-deductible debt in their owner-occupied home and recycle that into an investment debt or equity loan and invest more money, then that tax benefit will only increase as time goes on.
Yeah, kind of. It snowballs the tax benefit, but also the debt actually moves over to be non-deductible debt, and the non-deductible debt reduces over time.
Yeah, exactly. So yeah, we're just trying to in time, ideally, it's just completely turning it into investment debt, but that takes considerable time for a lot of people to do.
I mean, just touch on the
super.
insurance stuff because, to be frank, insurance is pretty boring.
Yeah, of course. Uh,
But it's like I'm a big
it's
believer in
super
insurance.
important, but yeah, it's
Yeah, because I want to get to some questions as well.
yeah, of course. So yeah, probably the main one to talk to on this slide is really that contribution to super. So by putting that money into super doesn't avoid the tax altogether, because when you put money into super as a concessional contribution, it's still taxed at 15%,
Mm.
assuming your taxable income, including super contributions, is under $250,000. Otherwise, there's another tax called Division 293, which is a consideration. But effectively, by them each putting $35,000 in, as a couple, they saved $30,000 in personal tax. So that reduced their tax bill from about $70,000 down to 40,
Mm.
from a personal tax point of view. But then they had to pay 15% tax. So the overall saving of that $70,000 was $19,000 in tax savings
Yeah,
in
amazing.
total.
Yeah, that's great.
And then, yeah, in terms of the insurances, so yeah, obviously the knee and the back that I mentioned means that Neil was able to retain that cover. For Neil changing his super based on some forecasted conservative returns of 7% a year, that was going to save him about 240 grand in super fund fee savings. And with Louise, we retained Host Plus but changed to a high growth option away from the balanced index option that she went into after reading the Barefoot many years ago book. And that just meant that, yeah, again, all based on assumptions, but historically the high growth fund at Host Plus had been outperforming the balanced option by a couple percent.
Mm. Mm.
Then just some bit of admin beneficiaries on the super, just making sure they were binding to each other. Louise had a sister nominated, which potentially would be an invalid nomination at the
Yeah,
time.
yeah. So I used to see that a lot, Scott, where a young client would come in and, yep, here's my super, and they've put their sister or brother on the
Yeah.
super nomination. That's an invalid nomination because they're not a beneficiary under the CIS Act.
Yeah, potentially, or like parents is the other one. And it's really the only category that the siblings or parents can probably fit into is the interdependent relationship category, which really is someone you physically, financially kind of care for, which who knows, at the time of your death, maybe you do physically, financially care for your sister, but right now we're dealing with the now. It's
Hmm.
very unlikely, or it wasn't the case. So
And an important question for you, Scott, would you physically and financially care for me?
always.
Oh, love it. But yeah, so that's just some housekeeping there, which is really important to make sure when and if, well, when you die, the money goes to who you want it to. And I would imagine, oh, and okay, interesting. Did Louise have the sister in place from a million years ago before she kind of shacked up with Neil and got married and all that? Or was it a conscious stuff you, Neil? I'm putting Louise down.
Well, we didn't have that discussion, so in
Not as
front of you.
frank.
No, so my understanding it was either in their early days or before they got
Yeah.
together, and it's just one of those things. I don't think Louise had even really checked her super until I asked her what her balance was
Yeah.
in a number of years. So, yeah.
Awesome. All right. Let's have a look here. Talk to us about the investment
Yep.
account.
Yep. Yep, cool. So yeah, so we're agnostic to the platforms. There's a lot of platforms that can be advisor only kind of platforms, or you need an advisor to set up, and there's a lot that the general public have access to as well. For Louise and Neil, we went for one that anyone can get access to, which is CMC Markets, and the main driver was that behind that was the cost. So we wanted to choose one that had low brokerage but also had good functionality, because they wanted to do more research and be more involved on an ongoing basis, and CMC Markets has has some really good kind of tools on the platform. Now, this was eight months ago, so if you ask me today, it might be a different kind of decision that we go down. But the idea here was to use a low-cost platform into a some diversified ETFs for kind of broadening out the investment strategy. The reason why we did kind of 5 in this case and not just say one, like a Vanguard diversified high growth fund or the beta shares equivalent or whatever it may be, was just to provide more flexibility in the future. If they were to look to sell down part of their portfolio, we could have options around what bucket we sell from and try to mitigate any future tax liabilities if they do need to sell it.
Right.
So it was just more of a future mitigation of that. Right, whereas if you're just in an all-in-one,
all getting pro rata sold down.
Yeah. So that was the reason. But yeah, there was I think one of the ETFs was the A200, so the top 200 in Australia. There was some America exposure, a bit of emerging markets, but that was only kind of 5% exposure, just for a bit more seeking a bit more opportunity in alpha there. But yeah, diversified portfolio there.
Yeah. Cash flow. Talk to us about this, because there's a few questions, and everyone, I've seen them in the chat, so hang in there. We will ask Scott at the end. There's some good questions there. And please, if you've just joined us, we're doing a value of advice session with Scott from Everest Wealth. And we're just going through a live case study. So thank you for joining us on your Monday evening. I'm your host, Glenn James. We'll be back after this. No, joking. Just felt like I'm doing a Monday night radio show.
Where's
all right.
your jingle? Or
yeah,
that in after.
Yeah, I'll put that in later. Talk to us about this stuff. I mean, we've touched on... Okay, and maybe we can almost start some of the questions.
Yeah, please do, because this is where I've tried to put in like what goes through our head when we're formulating a financial...
Yeah, so I'll we're putting that $400 a week onto the PPR offset account. Why isn't that just invested or into the loan itself?
Yeah. So it's not invested because we're going to look at that in 12 months' time to then potentially put a lump sum onto the mortgage, draw out an equity loan and debt recycle more money rather than investing it directly.
Oh, okay. So it's a strategic build up cash. Then when there's enough cash there, we pay down the loan, then review the mortgage, set up another investment split and invest that.
Exactly right.
Right.
Keeping it in offset now was just providing more flexibility for the next stage of life with potential children, things like that, just to keep more money flexible. Because if they were to put that $400 onto the loan, they may not be able to redraw it in the future. There's a 95% chance that it will be okay, but there's been stories in the past of banks applying that redraw to loans, and then if Louise is on maternity leave, maybe they can't borrow any more money based on their servicing. So it was just purely from, I guess, that standpoint and flexibility.
Yeah. Question. I'll go to Rhino's question. He's logged in from the Riff. Now, you wouldn't know where the Riff is, would you?
The Riff? Sounds cool.
Mate, it's the beautiful Penrith. So yeah, you're a Westie, and
big
Scott's based
place,
in...
Isn't it?
Sorry?
Big rugby.
Yeah, Penrith Panthers. The dynasty ended, I think, recently, or it's not. Anyway, I don't know. I don't do football. Scott's in Perth, but from Adelaide, and you've got advisors in almost every state now.
Yeah, so we've got an office in Perth and in Melbourne. A lot of what we do is via video as well, so we service effectively the whole country, but we've got staff and clients in every state of Australia.
Actually, just on that, I've got a question, and if you want to maybe reach out to Scott's team, I'll just pop the QR code on the screen there. Give that a zap. How much did this advice cost these people? I should have asked that sooner.
Yeah. So So we kind of break up our fees into the upfront initial work and then the ongoing. It's all, of course, optional. So, like, if you scan that QR code and book a meeting with us, there's no cost for that. That's just an initial kind of meeting to see if we can help, and if we can, where, what we would do and what we would charge. And then you make a decision from there. So the initial work for these guys included 3 meetings, a near 50-page financial plan, and the initial cost was $6,895, including GST. So that was for both of them. Some of that fee was funded by their super, because we were doing some work on their super, and paying for advice fees through super does attract a 15% tax deduction. Some of the fee out of pocket, because it was investment related, was also tax deductible. So we just tried to split it in the most tax effective way. And then in terms of ongoing, we charged an ongoing fee of $4,500 a year, but that was optional. So probably, Glenn, about 70% of our clients are not ongoing clients, and they're more one-off advice. Take the plan, we implement it. Yep, this is great. This has set me up now for 3 years, 5 years, however long it may be. And then now we've kind of been running now for 7 years. We're seeing many people come back to us from 3, 4, 5 years ago, going, what you did back then was great. I've now achieved that. What next? And just doing more of the ad hoc reviews. So yeah, that part is certainly optional if people do work with us.
Yeah, okay, cool. So I think one of the key things, because you're right, like there's a lot going on. The ongoing isn't compulsory. And, you know, as you said, only 30% of your clients actually do that for whether they need it or you don't think it's needed or they don't want it. That's fine.
A bit of both, yeah.
But the best part of 7K, there is going to be a huge chunk of that that's tax deductible, the portion that's in the super fund, if there's any tax advice outside of super. So that fee could net off maybe at 4.5K anyway, or less. But the big thing is, by, you know, engaging a financial advisor and doing things methodically and strategically, there was, in the first year, $19,000 of tax savings. So the advice paid for itself and more.
Are you selling me, or?
Yeah, I guess. I'm just saying you did a good job, my friend.
Yeah,
I don't know where I was going. I just think we've got to look at that, because a lot of people go to a financial advisor and go, oh, I don't want to pay $6,000 or whatnot. Well, number one, they're not going to take you as a client if they don't think they can add the value. And number two, if there's big life things that are happening, there could be strategies that you're not aware of that the advisors would be aware of.
Yeah, I mean, I'm biased, but I agree. But there's people quite often that we will turn away because they're already doing everything, or that we would have suggested anyway, or they're not quite in a position where we can add value for what we charge, and we just kind of give them a few tips and say, look, once you're in this position, come back and see us. So it's not in our interest to kind of charge $5,000, $6,000, and people only get $1,000 worth of tangible value, because that's only going to come back and bite us.
And just on that, I scanned the QR code because it worked. I thought I should test it. You may need to have a look, because there's no bookings available in August at Everest.
Right.
You guys are hot property.
Hot property. So yeah, usually there's about a 4-week wait time for us, and with the end of financial year, that just blew out a little bit.
Yeah.
But once, and I guess it's because we only let we work with a certain amount of people at once, just so that our, I guess, high level standard and service standards can remain, rather than you see us and then you see us again in 3 months' time. So it's kind of anyone that comes and sees us, then we start to see every fortnight or weekly, even depending on their needs for that initial period.
Yeah.
But usually, at this point in time, a little bit of a wait to initially engage with us.
And I'm about to answer the other questions, peeps, so just bear with me. I just wanted to ask this. If someone does want to book in for August, it's a 1-hour session and there's no cost, just to have that chat, and you will let them know if you can add value or not.
Yep,
Yeah,
absolutely.
okay.
Yeah.
Cool. All right, let's now ask some questions. Curious, why was the self-managed super fund not considered for passive index investments?
Yep. So was considered but discounted given their super balances. So combined their super. So Louise had 92,000 and 115 for Neil, so 200 in total, with the contributions getting them a bit above $250,000. We still felt for the fees and the risk of running a self-managed super fund themselves, they're just not equipped to, or didn't, and they didn't want to. Because with a self-managed super fund, as you would know, Glenn, there's kind of fixed costs of doing your own audit, doing accounting, tax returns, and then you still got the brokerage or the ETF kind of index fees anyway. And when we can use, say, Host Plus at 0.1% and kind of not have that burden, that was the pathway we took here.
Yeah, and most people, most of the time, do not need a self-managed super fund because the investments, the bread and butter equities and balanced portfolios, you can get anywhere. Okay, so that's good. Daz, hey Daz, thanks for jumping on. You're still with us from Vietnam. Originally from Brisbane, guys, but he's living in Vietnam at the moment.
Did you ask Riff's was it Riff from Penrith? Did you ask that question?
Rhino. Yeah.
Did you get sidetracked or?
Oh, I may have got sidetracked. May have. Well, I'm an idiot. When debt recycling, and we'll get back to Daz. When debt recycling, this is Rhino from the Riff, is the loan interest only or principal and interest?
Yeah, in this case it was interest only. Sometimes it's a bit of a mental barrier to have an interest only loan because you're not seeing that debt come down. But ideally in this case, when we're doing debt recycling like this, you want to keep it interest only and then keep smashing down your non-deductible debt so that then you can take out a higher equity loan and keep doing it. Then when you've fully got an investment loan, then potentially switch it to P&I, principal and interest, and start paying it off. But yeah, ideally interest only. A lot of banks only offer that for 5 years, and then sometimes you can refinance to interest only again. But it is, for some people, they like seeing the debt come down, so it's not always something that people opt for as well.
Yeah, no, that's cool. Actually, everyone, can you bear with me for 1 sec? Ryan, would you be able to do me a huge favour? The air conditioner next to the door, are you able to give that a flick? And it's just up there. I think it's the orange. It's just, we're in the studio and...
Getting a bit hot under the collar.
What's that?
Getting a bit hot in there, is it?
Yeah, so the studio's all locked down and all the lights in here, it gets warm. Yeah, that's perfect. And shout out to Ryan in the team who's with me here in the studio making sure that everything works tonight. So back to Daz's question. Having a 30K cash buffer in the offset account is pretty good, but could you place that money on your home loan and redraw it if required? If not, may I ask why? So maybe just rehash the offset account, because I think the offset account is doing what Daz is thinking.
Yeah. So offset and redraw work the same way in terms of how much interest you end up paying. So if we use, say, a $500,000 loan, if I've got $30,000 in the offset account, I'm only paying interest on $470,000 versus I've got a $500,000 loan, I put $30,000 onto the loan, my loan's $470,000. So the outcome is the same. What I guess I was trying to get at before was we suggested and recommended the offset account just to keep that flexibility, because there have been rare occasions in the past where the banks apply the redraw to the loan and then you have to apply with the bank to get that money back out as a higher loan again. And with people's situations changing, i.e. with Louise going on maternity leave potentially, they might not be in a position where the bank lets them borrow that money back. So it's just mitigating that risk. But sometimes, I guess, we do see people that prefer to have it on the loan because then it's out of sight. Temptation is then removed. If that's potentially something that would happen to that person, then using the redraw or putting it onto the mortgage is probably a better solution to avoid that temptation.
Rhino from the Riff, another question coming in hot. What percentage of the 7K fee came from super? Do you know off the top of your head?
Yeah, so it was about half. So it was about 3 to 3.5 grand from super, and then the balance 3.5 grand out of pocket.
Yeah. So the 3.5 in the super would have got a 15% tax rebate to the super fund.
Yep.
And then the 3.5 outside of super, if there was tax advice, and there was, because of the salary sacrifice strategies, that can be claimed on tax outside of super in both names. So, and that's when people say, oh, it's a $7,000 financial advice fee. Yes, that is a big amount of money, but we split some of it up where possible and put in the super fund. That claims a tax deduction. We appropriate an amount outside of super to the tax advice. So, as I said, the net amount comes down pretty good. And then he said, Rhino from the Riff also said, those that don't want yearly meetings, how many come back in the 3 to 5 years for further advice?
Yeah, so it's probably 20 to 30% have been over the last couple of years since we've been starting to properly track it as well. But there's plenty of people that it's just a quick phone call that we don't hear anything for 6-7 years, and we just touch base once a year just to check in and all good, move on. But yeah, it's definitely not 100% or anywhere close to that. Probably closer to 30%, Rhino. But it's kind of, I guess, people typically seeking advice normally is on a life event, falling pregnant, upgrading your home, getting a significant pay rise or inheritance, or that's typically when people reach out again.
Rob had a question. It says, a bucket company, full stop. We invest in ETFs. I'm interested in the advantage of a financial advisor over a sound structure with low-cost ETFs. Now, the minute someone's got a bucket company, that can often mean that there is potentially a family trust or another entity, which can, get pretty complex pretty fast. There's a lot at play there, isn't there? If particularly someone's self-employed, the level of turnover, the level of profit, how much they're drawing out personally to live off. Any comments there?
I mean, we come across semi-regularly the bucket strategy, family trust sort of situation. It's something that we've recommended a few times for certain situations, just to people that get large dividends from their business, as an example, and don't want that all flowing through to their personal names. A good way is to put that money into a bucket company and pay tax at the company rate, which is typically lower than their personal rates at maybe the top marginal tax bracket. The question, though, was around kind of the advantages of using an advisor versus just having the bucket.
I think he says, I'm interested in the advantage of financial advisor over a sound structure with low-cost ETFs.
Yeah. Well, I mean, that could be the best avenue. I guess where a financial advisor generally comes in, or speaking for us, is more firstly at the strategy level. So does it make sense in your case to maybe keep piling money into the bucket company, or is there a better structure? Or should we be focusing on, I don't know, paying down the mortgage, putting money into super? So there's that kind of strategy discussion. And then from there, it's the products from that. So whether it's a platform for investing, whether it's the particular ETFs. So that's what we can also provide advice on and review. But seeking financial advice as well isn't going to be for everyone.
No, that's right. Sarah Another one from the Riff. You would not believe it. We've got half of Penrith watching tonight. There's about 7 people watching. No, I think there's about 40-ish. We do these for the replays, so a lot of people won't be able to watch it live. Thanks, guys. A great episode reminding me to follow up on financial advice. Now, I need to get home and get tucked into bed because it's 8:30 and it's a school night. Scott, any final comments on this case study? I'm just kind of keen to to not keep everyone hanging, and I haven't seen any other questions come through, but it's been a really good high-level example. But any final thoughts or comments?
Yeah, for me, it would just be reaching out to a financial advisor, because most, like ourselves, do offer at least a 15-minute introductory call free of charge. For us, it's kind of that hour sit-down, face-to-face meeting or via video. Before you make any big life decisions like selling a property or buying a property or starting a family or whatever it may be, because there are typically things that you may not have thought about or implications down the line. Like another common one, and I know this is around kind of having children again, but a lot of the time we see people kind of upgrade their home, buy the $1.5 million property, and then kind of have that oh crap moment. It's like, how do we afford this when we drop an income? So it's just kind of whatever we do, it's always not just looking at the now, it's the future. Just I guess encouraging people to talk to someone earlier on, and it's financial advice isn't just reserved for the ultra wealthy retirees. There's obviously a big space for that, but it's not just for those people as well.
Yeah. And if you are, what I'm going to do, I'm just going to put in the chat, if you are watching this and you are over age 50, 55, Everest, you don't strictly provide retirement advice, but I'm going to put Retire Right in the chat. If you want to go to that website, click Get Help, and I will have a look and refer you to a suitable financial advisor if you are over that, if you are, we'll call it 10 years out from hanging up the tools.
Good idea.
I think that's all I was saying, Scott.
Didn't know if you were looking at me to back you up then, or what?
Yeah, back me up, bro.
Yeah,
back me
all
up.
right, go.
Yeah, go for it. But yeah, we might leave it there. It's right on an hour. I just wanted to spend an hour with everyone. Thank you so much for watching tonight, everyone. If you're watching the replay, thanks for watching. Please don't hesitate to reach out by the QR code to Everest Wealth. Book in complimentary discussion. Spend an hour with one of the advisors. And I can tell you, if they can't add value, they will tell you. They're not interested in taking people's business where they can't deliver some type of value. So,
thanks for having me, Glenn.
No worries, Scott. And thank you so much, everybody. Really appreciate it. Did you write that, Ryan, or did it automatically come up? It automatically came up through Ryan. He wrote, "Thanks for all your great questions, guys."
And next live event in Penrith, by the sounds of it.
Yeah, that's right. We're going to go to the Penrith Ari, and the Panthers. It's the football club. We're going to do a live event there, hit the pokes, and make our financial plans come true. Just kidding, maybe. Thanks, Scott, and thank you, everyone, for watching. Yeah. We'll see you soon.
Thanks, guys. Good night.
See ya. All right. End stream.